Did you know you can invest in crypto without holding the actual coin, and at the same time, manage your investment risks? Well, one of the ways you can do that is with a crypto futures contract. In this video, we'll talk about what crypto futures contracts are, how they work, and why they are important with easy-to-understand examples. A crypto futures contract is a type of derivative contract. The word derivatives means that the value of one thing is based on another source. In crypto, a derivative contract is a financial instrument where its value is derived from an underlying asset, which in this case are cryptocurrencies. So for a Bitcoin futures contract, the value of the contract is derived from Bitcoin. Going back to crypto futures contracts, it is a financial contract where two parties agree on the buying and selling of an underlying cryptocurrency at a specific price and date in the future. For example, there are two traders, Jane and Clark, who wanted to open a long and short futures position on a contract to buy and sell Bitcoin, where the agreed upon price of one Bitcoin is $20,000 on the 31st of January. Now, on the 1st of January, the current price of Bitcoin is $20,000, and Jane is bullish about Bitcoin and thinks it will be worth more than $20,000 by the 31st of January. Thus, she decides to open a futures long position on Bitcoin. This means that regardless of the market price of Bitcoin on the 31st of January, she gets to buy a futures contract that offers one Bitcoin at $20,000. On the other hand, Clark is bearish and thinks that Bitcoin will be worth less than $20,000. Thus, he decides to open a futures short position on Bitcoin. This means that regardless of the market price of Bitcoin on the 31st of January, he gets to sell a futures contract that offers one Bitcoin at $20,000. Scenario 1. The 31st of January comes and the price of one Bitcoin is $25,000. Having bought the Bitcoin futures contract at the price of $20,000, Jane gets to profit from the $5,000 difference. Clark, on the other hand, took a short position, thus he has to buy back the futures contract of one Bitcoin at the price of $25,000, which he sold at the earlier price of $20,000. The opposite happens when the price of one Bitcoin drops to $15,000. Having bought the futures contract at the stated price of $20,000, Jane made a loss of $5,000. Clark, on the other hand, would have made a profit of $5,000 as he gets to buy the futures contract of one Bitcoin at $15,000, which he originally sold for at $20,000. Again, they only trade the equivalent value of the underlying asset, and not the cryptocurrency itself. In most cases, these are transacted in cash, thus it's called a cash settlement. So why is understanding crypto futures contracts important? Well, because there were some really crucial advantages to trading futures contracts. Firstly, it offers leverage opportunities. It provides a multiplier mechanism to the capital to trade crypto to amplify the number of derivative contracts you can buy or sell. This allows traders with smaller capital to still trade at a large amount. To understand how this works, we need to look into initial margin and maintenance margin. Initial margin refers to the minimum amount to put up as collateral to open a position that can be larger than the collateral value, while maintenance margin refers to the bare minimum that the initial margin has to keep the position alive open. If the market moves against your position and the value of the unrealized loss is equivalenting to your initial margin value, if you did not inject more funds into your position, should the percentage of the unrealized loss cross into the stipulated maintenance margin threshold, the trading platform will then force your position to be liquidated. For example, say if Jane wants to invest her $1,000 capital to buy long on Bitcoin with a 10x leverage, she could open a position worth $10,000 with her $1,000 as the initial margin. If the price of Bitcoin goes up by 20%, she would earn a net profit of $2,000. However, should the price drop by 10% from the position's entry price, she could face liquidation risk if no funds were injected to cover the unrealized loss. Another advantage of crypto futures is risk management. Say, for example, Jane holds actual Bitcoin and the price is going down. As she is also a crypto derivative trader, she can then enter a futures contract to sell Bitcoin at a higher value than its speculated value in the future, which value goes in the opposite direction of the actual Bitcoin price. This ideally offsets the losses from the Bitcoin she holds with the gains for her futures contract. All in all, There is no single formula that guarantees profits or mitigates losses. You can, however, follow certain practices to safeguard yourself and trade carefully, knowing the risk and what you can afford to lose. So are you going to experiment with crypto futures? Let us know in the comments below. And if you'd like to learn more about crypto, you can check out our articles in the link provided below. Don't forget to like, subscribe, and hit that notification bell, and we'll see you next week.